Welcome. I'm Mark Kennedy, Director of the Wahba Institute for Strategic Competition here at the Wilson Center. Today we're very thrilled to have our chairman, Dr. Sadek Wahba, who is recently written a book called Build, Investing in America's Infrastructure. It's an excellent book covering a very important topic. We're thrilled that he would take the time to be here with us. Thank you for being with us, Dr. Wahba.
Mark, thank you very much for having me here at the Wilson Center.
You bring so much experience to this topic. You are a PhD from Harvard, but you were an economist at the World Bank. You worked at Morgan Stanley in infrastructure. You now run one of the largest infrastructure investment companies, and you were on the President's Infrastructure Committee. So you bring so much wealth to the topic, and it's a very important topic for America. Let's begin by talking about, you say that infrastructure is really the lifeblood of our business community, of our society. Talk about just how important infrastructure is to us.
So let's define what infrastructure is, just to start with. And infrastructure includes bridges, it includes roads, it includes digital network, the fiber that connects to our home, so that we can have connectivity to the internet. It includes water, wastewater systems, bridges, airports, and we can continue. So it's a critical part of our daily life. Maybe we don't appreciate it, but without it, we wouldn't be able to function. And if you take a step back and look at the statistics, there's a very clear causal relationship between investing in infrastructure and economic growth. So the more you invest in infrastructure, the higher economic growth you get, the greater productivity you have, labor and otherwise. So there's a direct link between the two. There's also an important link between investing in infrastructure and income inequality. Many studies have shown that when you invest in infrastructure, you're able to reduce income inequality. So investing in mass transit systems has a big impact because it allows low-income households to be able to travel, to move around in a way that maybe otherwise they couldn't if that mass transit system was not there. It has a big impact for emerging economies. China in the 1980s decided they wanted to grow through an export-led economy. That could not have happened without the roads that takes the goods, the manufacturing goods to the ports, which meant that you needed the port, you meant that you needed the power, and so on and so forth. So it's an essential part of our life.
It is an essential part of our life, as you just described, and it drives the economy, and yet we have had a chronic funding gap that has not kept up with that and had negative impacts because we have not funded it. Talk about the funding gap we have.
So the US has invested in infrastructure since colonial days. But if we look at the numbers and the percentage of infrastructure investment to GDP since the 1970s, it's been around 2% or less. How does that compare? I just mentioned China. How does that compare to China? China has invested 8% of its GDP in infrastructure, so 4 times higher than the US. Now, true, the US starts from a much higher base, but 8% compounded over a period of 40 years really catches up very quickly. So we have had a massive funding gap over the last 40, 50 years, which has had a severe impact on our infrastructure writ large.
And when you look at a solution to that, I mean, there's been a couple of major bills that have moved forward on infrastructure, and yet that funding gap still remains. Part of the main point of your book is that there's a role for private investment. And you describe the need for a new way of investing and managing infrastructure, suggesting that having the government be on all sides of the equation, both the regulator as well as the investor and the owner, isn't optimal, and that there's a new way that can involve private investment more. Describe that new way and how it can benefit, and how the current method that we're on is just suboptimal.
So let me take a step back. 40 plus years of underinvestment in infrastructure has led to a general deterioration in the delivery infrastructure services. So you have over 2 million people who don't have access to water. You have over $70 billion of lost economic value because of the big issues we have in supply logistics for trucks that have to stay idle for many, many hours and days. You have over 70,000 bridges that need to be upgraded, and so on and so forth. The Biden-Harris administration was able to pass a bill a couple of years ago, 2 years ago in fact, which is the infrastructure bill of $1.2 trillion. What's extraordinary about that bill is that it was actually passed and passed on a bipartisan basis, because every administration prior to that has tried, both Republicans and Democrats. Former President Trump tried, President Obama tried, President Bush, President Clinton, and so on. And many of them succeeded in one way or another, but not in the magnitude. So at the end of the day, it required 40 plus years to suddenly being able to do that and pass that infrastructure bill. So that $1.2 trillion is huge, very important, has helped, especially that the administration really learned from the past by saying, how can we trickle down that those funds to support the infrastructure across the different states. So they put in an administration, they put in a system so that it really goes down to the particular projects. The problem, of course, is 1.2 trillion, of which, to be fair, 500 is a reappropriation of the transport bill. So fresh new money is $600 billion. $600 billion over 50 states, over thousands of projects, helps launch a new era in infrastructure. In many cases, upgrade smaller infrastructures, but if you want to build or rebuild a new $2 billion bridge, you may get from the infrastructure bill 50 million, 100 million, but the rest has to come from the state. And the states don't have the money. So how do we solve that? I think it was good for the government to provide $1.2 trillion, but is that sufficient? No. Is it necessary? Yes. Question is, how do we get the additional funds? You will only get additional funds if, as you suggested, the model that we currently have is fundamentally changed. So what is that model that we have for the last 50 years or so? That model is one where, for traditional infrastructure, not power generation, let's be clear, but for traditional infrastructure, the state, and by state I mean it could be a municipality, it could be a city, it could be a state, it could be the federal government, but the state, the government, owns the asset, manages it, and regulates it. And so when you have the three in one, you create conflict issues, you create an inability to monitor the quality of the service, and so on and so forth. So we need to be able to, number one, separate the three. And I'll give you a very simple example. Our power utility model for every state is, first of all, privately owned, for the most part, by companies that are listed on the New York Stock Exchange, that you and I or anyone else can buy. They are regulated by Public Utility Commission in that state. And of course, there is federal oversight. That Public Utility Commission negotiates on behalf of the people of the state what return and investment that these utility companies should do and have. Typical returns for utility companies is, call it 8 to 12% equity return. Let's now look at the water sector in any state. The water sector has many, many, many thousands of operators, not 3 or 4, that can serve a small community of a couple of thousand people to maybe 50,000. There's no combined regulatory authority. And the supervisory body at the federal level is the EPA, that doesn't have the resources to be able to prosecute and do its business in terms of supervising these water authorities. So a quick comparison, the United Kingdom has about 11 water authorities for the entire UK. US has, guess, a lot.
Hundreds of thousands.
You knew the answer. Has 55,000 water authorities. So when they have 5,000 water authorities across the states, it becomes impossible to manage it. So a simple answer is combine within a state the water authorities, whether they privately operated or not. That's, at this stage, that's not the issue, into one public utility commission that works with these authorities, allows them and gives them the ability to increase the rates. Why? Because they'll be spending more money. That system doesn't exist in the water, it exists in the power utility sector. Can we replicate it? The answer is yes. Can we do it? The answer is yes. Is it structurally easy to do it? Yes. Is it politically easy to do? As a former congressman, I ask you that question, and I won't answer it because you're much better qualified to answer that question. So I think that's one solution. Another solution is the development of and the creation of an infrastructure bank. So many people say, oh, yet another institution, yet another organism, another bureaucratic system. No, I think the idea is to create an independent private organization supported by the government, like a GSE, that has the ability to effectively lend on commercial terms to infrastructure projects, provide equity, mezzanine, and so on. And I think that will be extremely important and extremely helpful to maintain the ability to identify funds over the long period of time and not wait for another 30 years for the government to issue another $1.2 trillion. And then the third is the involvement of the private sector. I know, I'm sure we'll talk about that. Private sector is very keen to invest in infrastructure. Infrastructure provides a long-term, steady return. And by private sector, I mean pension funds, could be private pension funds, corporate pension funds. It could be state pension funds that represents the nurses, the firefighters, the teachers, the state employees of that particular state. So there's a great alignment of interest. It could be private capital. It could be, why not, foreign capital, as is the case in the utility sector. So there's many ways in which we can galvanize capital to invest in our infrastructure over a sustainable period of time and not have this disastrous outcome where we wait for 50 years for the government to give us money, and unless the government gives us the manna from heaven, no one will want to do anything about it.
And if we had time to dig deeper, for example, the water example that you gave, there are needs out there that are not being met.
Absolutely.
There are small communities that are not able to meet their water needs. And so there's part of that gap, which is in the trillions, is in water and having negative consequences for people. As you already mentioned, the number of people that really don't have access to the water they need. We mentioned the private sector. If you and I travel around the world and we bump into more privately owned transportation, other infrastructure than we see here in America. In America, about 1% of infrastructure is what we call P3 or PPPs, public-private partnerships, whereas abroad, it's often 20 to 30%. Talk about what lessons we can learn. We're not trying to do this out of whole cloth. This has been done over and over again in multiple countries. What are the lessons that America can learn from those countries that have already adopted P3 models that we could bring here?
The P3 model, as you say, public-private partnership, is based on some form of contractual agreement between a private entity and a public entity, and the idea is that they can collaborate to manage, improve, grow a particular asset. It could be a water company, it could be a bridge, it could be a road, and it can build it from scratch, or it can take an existing one, improve it, and extend it. So all of these are possible. Who has adopted PPPs? Just about everyone. Canada is a big user of public-private partnership, the UK, France, across different sectors. So it could be roads, it could be airports, it could be water, and there's different models. The United Kingdom in the 80s went to the extreme, as it were, where they privatized 100% of the water sector, they privatized 100% of the gas distribution sector, they privatized 100% of the airports, and so on and so forth. And when I mean privatization, to go back to the model I just mentioned, which is ownership, management, and regulation, the UK government under Prime Minister Thatcher privatized as in sold 100% of the rights, assets of all UK airports to the private sector. What they retained was the regulation. So they created an independent regulator for the airports, they created an independent regulator for the water sector, and so on and so forth. China, a communist country, has public-private partnerships in the water sector, in the transport sector. Many of them are owned by ultimately government-owned entities, but those government-owned entities are listed companies in the stock market. You can buy them, if you can buy stocks if you want. You ultimately can't get control of those companies, but those companies are run on the basis of maximizing profits for their shareholders, and so you can buy stocks in airports, in roads, in water companies, and so on and so forth. So that model is available, has been used for the last 20, 30 years. There's ample data, great experience of what went right and what went wrong, and we have the ability in the US to be able to take all of that information and implement it in a systematic way and improve on it.
Well, and not only can we need to, because we're the Wahba Institute of Strategic Competition. When you look at strategic competition, you already mentioned the difference in what America's investing in infrastructure versus what China is. You've already mentioned that the more you invest in infrastructure, the more economic vitality and resilience and less income inequality you have. By us not doing that, I mean, part of the frustrations, we're really focused on clipping the wings of the dragon, but not on furling the wings of the eagle. Talk about why in this competition setting, America really has a compelling need to invest more in infrastructure to make sure the economy stays as vital as it needs to be.
I firmly believe that a strong domestic economy leads to a strong foreign policy, and a strong foreign policy leads to a strong domestic economy. So the two are interrelated. From my perspective, having a strong domestic infrastructure allows you to, first of all, have great economic growth, more sustainable economic growth, an ability to have better logistics system, an ability to export more or facilitate exports, and so on and so forth. That has a big impact on overall foreign policy. The second thing is, when we think of the US projecting its aid and its cooperation with other nations, what we have done to date is really encourage people not to work with other countries, but not provide a clear long-term sustainable solution. And I don't think that makes a lot of sense. And more importantly, it's not the kind of thing, as I said, that is really sustainable. We need to be able to find longer-term solutions in which we're able to provide countries in sub-Saharan Africa, in Latin America, in Asia, with meaningful alternatives where we can help them build their infrastructure via the World Bank, via cooperation with the EU, and, as I've argued in the past, and I argue here in the book, via cooperation actually with China. We have, as I call it, a global competition with China. We cooperate in some areas, we compete in others. One area that people have agreed that we should clearly cooperate with China is on climate change. But infrastructure is very much related to climate change. So is it helpful, is it beneficial for everyone to participate in the development of an airport in a country in sub-Saharan Africa or Latin America? The answer is absolutely. Or help develop and expand a particular port jointly? Absolutely. All of these are areas that we should collaborate. I mentioned, as you know, in the past, the collaboration with a country like China on water technologies. We have a water crisis in the US. China has a major water crisis. Sub-Saharan Africa has a major water crisis. Water is going to be the dominant issue for this planet over the coming years as part of the fundamental changes that we see in climate. And the fact that there is scarcity of water in areas, abundance of water in others, in fact, abundance to the extent that it's creating major damages. So how do we manage all of that water resources? What kind of infrastructure and technological changes we can bring to make water more efficient, dealing with sanitation, dealing with groundwater levels, dealing with desal facilities. All that requires technology. a collaboration between us, China, and countries like Singapore, Israel, we have great technologies around water, can create a water technology fund that is beneficial for the entire planet. These are the kinds of ideas and areas that we should focus on, as opposed to trying and constantly being negative.
These issues you're talking about, water, we don't oftentimes think about, but it's bigger, frankly, than all of us. To have all of us together on it, we're still going to have a hard time tackling the issue and providing safe drinking water and other water needs. That's just one form of infrastructure. So you're right, we do need to be addressing those. Now, the other interesting thing is we think of ourselves here in America as a market-driven economy. And we oftentimes think that that gives us an advantage vis-a-vis, say, a China that has supposedly a government-driven economy. Yeah. But if you look at just the water comparison, as you alluded to, it's very dramatically different. I mean, explain how that difference is and how America should maybe follow its own instincts and use more of a market-driven approach.
90% of the water assets or more in the United States are owned by government. Take the United Kingdom, 99% is owned by the private sector. Is it self-regulated? Absolutely not. Does it have a regulator? Yes, government regulator. Is that regulator very good at doing his job? Yes. Does it have flaws? Absolutely. Have we had issues in the United Kingdom related to some water companies? Yes, it's in the news and people can read about it, and the government's trying to improve the system. But that model has allowed for massive investments in infrastructure in the water sector, a massive improvement over the years in terms of the quality of the water that we haven't seen in other parts of the world. In the United States, we are massively underinvested, not just in terms of water infrastructure, but in terms of issues related to technology, as I mentioned earlier, and to cybersecurity. So, for example, today we are exposed to cybersecurity risk, and our water infrastructure, which is exposed to that, needs to invest billions of dollars to upgrade the system. You can't protect unless you have modern technology that operates these water systems, and that is a lot of money. Who's going to pay for it is the question.
Well, somebody needs to pay for it, or we'll find ourselves without water. Now, we go to Europe. You mentioned UK already, but if you look at ports, Europe, generally about 43% of the airports have at least some private interest. US, it's 1% or less. Now, that impacts US ports, but part of what we see is a whole lot of the rest of the world wants ports, airports, seaports. We don't have any private operators to operate ports because we don't have any private ports, air or sea, really, of scale in America. So it's other countries building those ports, which is a lost economic opportunity. But also you find that China has 100 ports, seaports around the world. We just averted a longer port close down on the East Coast and got more indications of what economic impact that would be. How can we get to being more sensible in the way we manage our ports and having more of a global reach with the capabilities we are building here in America?
So on the domestic front, the US has an interesting model, which is most of the ports are, of course, owned by the individual states and so on, and cities and various authorities. But they, to go back to our model, ownership, management, and regulation. Ownership is generally almost all with states. And by states and government, I mean various authorities and so on. But they're managed by the private sector and regulated under very specific regulatory regimes. So that's a good model and has been broadly successful. The fact is, it's not the port authorities that have an issue. It's the overall ecosystem around the ports, both state and federal regulation, that prevent an expansion of these ports, environmental, permitting, whatever. And so I think that's one challenge that we have. But I think the model is a good model. When it comes to our presence overseas, at the end of the day, because we don't have a US-based, or we don't have many US-based port operators, they haven't really looked at investing overseas. So most of the ports, as you mentioned, are under long-term concessions by shipping companies, which could be Danish shipping companies, it could be Swiss shipping companies, French shipping companies, which are the three largest in the world, Chinese shipping companies, Japanese shipping companies, and so on. And Abu Dhabi or Dubai shipping companies, or port companies, I should say, that have invested over the last couple of decades in international ports. Number one, because it's a good return, and it's highly correlated to global economic growth. And then the third one, when it comes to China, China was very smart at investing in ports because they wanted to ensure that they have access to supply for their primary goods, whether it's agricultural goods or commodities that they need for their sustainable economic growth objectives. So they were able to do that, but they did it, by the way, by also generating a profit for themselves. So it's not that it was a purely strategic objective that doesn't make returns, not at all. The best example I can think of is what China did with the port of Piraeus in Greece. 100% government owned, the most ineffective port in the world. This is the port, the port that we all know about from Greek mythology, Piraeus, but the worst managed port in the Mediterranean, if not globally. China came in, stepped in, took 40%. Today, that port has quadrupled its volumes. It's the most effective and largest port in the Mediterranean.
And as you say, they're doing it for sound reasons, and not only getting a return, but making sure they secure their supply. The challenge is we haven't gotten America, as we've said, to think about our ports, about our infrastructure here in America enough, much less how dependent we are with all that other infrastructure around the world. But we've already alluded to, my last question is international infrastructure. I've become convinced that infrastructure is the conduits through which future commerce flows. So if we really want to have more trade, more facilitation, more exports, investing in this infrastructure abroad makes sense. If we want to build relationships diplomatically, if we want to make sure that things like our free flow of goods are secure, supporting international infrastructure is increasingly important. We have the Development Finance Corporation that is due for reauthorization. Could you just maybe end with how important it is that we reauthorize the Development Finance Corp here, hopefully even in the months ahead?
So the Development Finance Corporation, which was created I think in 2016, which includes various agencies, principally OPIC, which was the Overseas Private Investment Corporation, is the arm of US government to bring in capital alongside private capital that invests globally. That, in my view, is the single most important organism that we have in the United States that allows us to invest outside and support private capital to invest globally. That reauthorization is absolutely critical. What both houses have done is added to the reauthorization so it can expand the mandate of the DFC by including more countries, by allowing a bigger part of its capital to be treated as a different risk profile, if you want, so that allows for greater leverage of its capital. So I think that reauthorization absolutely critical for the US when it comes to its foreign policy. And that, in a way, is linked to domestic policy. Why? Because the DFC is encouraging small to medium-sized enterprises to invest overseas, open new markets, and that's critical. At the end of the day, we will never, in my view, succeed globally unless we succeed first and foremost domestically. We need to have a strong domestic economy. We need to have a strong domestic infrastructure that provides the basic service to its citizens. If we do that right, we will have the human capital, the technology, the infrastructure to be able to share it with the rest of the world, and that's where we have to start.
Well, thank you for that important message. That is the message of the book that we're talking about, Build, Investing in America's Infrastructure by Dr. Sadek Wahba from Georgetown Press. We're thrilled that you were able to be with us here today. Again, I'm Mark Kennedy with the Wahba Institute for Strategic Competition here at the Wilson Center. Thank you for being with us. Stay with us for future programming.
Thank you.